Jones, and you're tuned in to the Deep Dive channel. Settle in for a smooth 5-minute tour of Week 17, 20 to 27, April 2025. We'll connect the dots so the raw numbers tell a human story. North America. We'll begin at home. United States. March retail sales rose 1.4%. Impact, stronger near-term growth in jobs, but hotter inflation keeps mortgages and credit card rates high. Canada, sales rebounded 0.7%, good for retailers and hiring, yet pushes any Bank of Canada cut further out, so borrowing stays costly. Mexico, the World Bank cut its 2025 growth call to 0%. Slower factories mean fewer jobs and tighter budgets, clearly negative. Europe, crossing the Atlantic, the policy pendulum tilts towards stimulus. Eurozone ECB, officials are guiding markets to a 25 BP cut on 4 June. Cheaper credit should help firms invest, but underscores a fragile recovery. United Kingdom, PMI at 48.2 signals contraction. Lower confidence and a wider deficit point to weaker jobs and a softer pound, negative. Germany, forecast trimmed to 0.1% growth, practically flatlining. Wages stall and green investment budgets shrink, again negative. France, outlook paired to 0.7% with 40 billionaire in savings. Tighter public spending hurts households short-term, yet preserves bond market trust. North Africa, down the Mediterranean, fortunes diverge. Morocco, inflation at 2.3% YY, stable food prices and room to cut rates, a positive for families and SMEs. Algeria, hydrocarbon receipts fell 8% QQ. Fewer petrodollars mean possible subsidy cuts, negative for living standards. Egypt, a bold 225 BP per cut after inflation dropped to 13.6%. Cheaper loans spur business, but savers lose income and a weaker pound could lift food costs. Sub-Saharan Africa. South Africa, CPI at 2.77%, a 5-year low, positive for purchasing power. A May rate cut is likely. Nigeria, inflation re-accelerated to 24.2%. Food costs bite, eroding wages, decidedly negative. Shar, Asia-Pacific, pivot east to contrasting policy paths. China, PBOC signals easing while BYD doubled profit. Easier credit helps small firms, EV strength supports tech jobs. Positive, though broader growth worries linger. Japan, Tokyo core CPI at 2.6% squeezes real incomes. Consumers feel the pinch, negative, yet nudges the BOJ toward normalization. India, flash PMI at an 8-month high boosts job prospects, but a weaker rupee raises import prices, mixed. Latin America, Brazil, rolling 18.4 billionaires of FX swaps steadies the real, good for inflation, but a 1.8% growth forecast warns of a slow labor market, cautiously negative. What it means for traders and for people. Rates. Eurozone, South Africa, and Egypt look set to cut, relief for borrowers. Fed and BOJ stay on hold, keeping U.S. and Japanese debt costs high. FX. Dollar dominance persists, inflating import bills. Rand and real get breathing room. Euro and rupee stay fragile. Equities. Chinese EV boom lifts tech jobs. UK domestics soften, hinting at layoffs. LATAM exporters brace for muted demand. Macro theme. Tariff escalation fragments policy, widening the gap between strong currency and weak currency consumers. Looking ahead, next week expectations, commodities. Brent could drift toward cheaper fuel, but pressure on oil-dependent budgets. Gold near 2,300 protects savers, but cools jewelry demand. Crypto, Bitcoin is coiling. A break of 62K or 57 should spark the next 10% move. ETF flows are the spark to watch. FX. A hot U.S. employment cost index may push the DXY to 107. CAR US dollar support at 1.05 marks the line between slowdown and deflation fears. Key shares. Apple's Tuesday earnings will show if consumer tech fatigue is real, impacting supply chain jobs worldwide. Shell's Thursday update tests big oil's ability to fund dividends with cheaper crude. That wraps up this week's key economic highlights. If you like the content, don't forget to hit like and also share and subscribe. Until next time, trade smart.